Hey everyone, and welcome to This Explainer. I am absolutely thrilled to have you with us today. We're going to take a fascinating little journey right into the financial engine room of customized businesses. We're literally deciphering specific order costing methods. Basically, these are the exact step-by-step techniques that companies use to figure out exactly how much a unique job, a batch of items, or a massive long-term contract actually costs them to produce.
Okay, let's dive into this. It's honestly one of the most common fundamental anxieties in the entire business world. If a customer comes up to you and asks for something entirely bespoke, whether that's a custom pair of shoes, a massive print run of booklets, or, an entirely new suspension bridge, how do you set a price that guarantees you won't end up losing money? Because if you just guess, well, you're gambling. And in business, we really don't want to gamble. We absolutely need precision.
And that brings us to our core definition, order costing. So this is a specialized accounting technique, and it's used specifically by organizations that produce products or services to a customer's unique, exact specifications. It's a system that's meticulously designed to link every single ordering expense directly back to that custom product or service. The ultimate goal here? To determine the precise profit or loss realized on each individual order.
Here is our game plan from today. First, a quick intro to order costing. Second, job costing for those custom fits. Third, batch costing for when you're scaling up. Fourth, contract costing for long-term builds. And finally, the tricky business of calculating unfinished profit.
All right, jumping right into section 1, intro to order costing.
You might be wondering, why go through all this meticulous, crazy record keeping? Well, order costing matters immensely because it determines your total cost per order as accurately as humanly possible. Honestly, this is the only way a business can clearly distinguish its highly profitable operations from its totally unprofitable ones. Plus, it lets management compare their current costs with past estimates to see if productivity is actually genuinely improving. Oh, and if you ever want to do business with the government, this system forms the absolute bedrock for cost-plus pricing, which is where contracts are priced on an agreed cost plus a target profit. You literally can't prove your cost without this system.
Moving right along to section 2, job costing, where we'll look at custom fits. Okay, before we throw a bunch of numbers at you, we really have to understand a concept called absorption. Now, direct costs, things like your materials and wages, those are pretty easy to track to a specific job. But what about the factory rent or the electricity bill, the manager's salary, right? Those bills definitely do not pay themselves. These are what we call overheads. So absorption is this crucial, somewhat complex method of fairly charging those general production overheads to the specific units or jobs that are passing through that cost center. Because overheads can't be traced directly to a single item, businesses have to use arbitrary but logical basis to absorb them. To handle this, a company might say, hey, we're going to charge overhead as a percentage of our direct labor costs, or maybe they'll use a percentage of direct material costs. They could even base it on the literal hours a machine is running. Basically, the choice depends entirely on what drives the costs in that specific factory. Like, if wages make up the vast majority of your total costs, using a percentage on direct labor makes a whole lot of sense. Now, what's really interesting about this is how it all comes together in the real world. Let's look at Star Modern Shoemakers from Kano, Nigeria. Say they produced a single job of 500 pairs of custom shoes. They tracked their direct wages at 8,000 naira, direct materials at 5,000 naira, and direct expenses at 1,500 naira. Add those up, and that gives them a prime cost of 14,500 naira. But hold on, they aren't done yet. They absorb their production overhead by taking 30% of their direct wages. Since 30% of 8,000 is 2,400 naira, they add that in, and their true production cost comes out to exactly 16,900 naira.
But wait, there's more. The business also has administrative and selling expenses, right? So Star Modern Shoemakers charges admin expenses at 15% and selling expenses at 10% of that production cost we just found. When you add those final overheads into the mix, the total cost for the whole job hits 21,125 naira. Divide that by the 500 pairs of shoes in the job, and boom, we get our magic number, exactly 42 naira and 25 kobo per pair. Now they know exactly what price floor to set so they don't lose money.
Which brings us to section 3, batch costing, all about scaling up.
So batch costing covers things like, say, a print run of 1,000 books, or maybe a whole batch of shirts, and it's got some very peculiar features. First off, you have your setup costs. This is the engineering time or factory consumables you need just to set up the molds or the machines in the first place. The big takeaway here is that your unit cost will actually decrease as your batch size increases, simply because those setup costs remain completely fixed. Plus, you can even batch completely dissimilar products together if they happen to share a common machine operation, just to save on that setup time. Pretty smart, right?
And this brilliantly illustrates the absolute power of batching. Look at the Angingba Press example. Notice how the setup and fixed overheads cost 700 naira, whether they print 5,000 booklets or 25,000 booklets. That 700 naira setup cost absolutely does not change. It stays completely fixed. Now, of course, the materials and wages do go up because, well, they're printing more books, which results in a higher total cost for the larger batch. But look at what happens to the unit cost. Because that fixed 700 naira setup cost is being spread out over 25,000 units instead of just 5,000, the individual cost per booklet just plummets. It literally drops from 19.24 kobo all the way down to just 8.04 kobo per unit. This stark comparison right here, this is the mathematical proof behind economies of scale. All right, let's shift gears to Section 4, Contract Costing, looking at long-term builds. Contract costing is what you use for massive projects like building bridges, roads, or huge housing complexes. And the life cycle here is totally different from quickly whipping up a batch of shoes. In year one, a long-term job begins directly on the client's site. Remember, it's not in your factory. By year two, you're likely bringing in entirely separate subcontractors to handle really specialized tasks like the plumbing or electrical installation. And finally, when it's done, you don't just get to decide the value of the work yourself. An independent architect actually assesses the work and issues a valuation certificate. And that right there is what dictates what the contractor actually gets paid. Now, ascertaining the cost of a contract is actually pretty easy. You just aggregate all the expenses into a contract account. But here's the narrative bridge we really need to cross together. What happens if your custom job takes 3 whole years to finish, but your investors or shareholders want to know your profits at the end of year 1? You haven't even finished the job yet. So how do you legally and ethically claim a profit on something that is literally still a work in progress? That perfectly sets up Section 5, Calculating Unfinished Profit. Let's move to a fairly advanced contract and see how this builds. Accountants use a very careful 2-step process here to avoid overestimating success. Step 1 is calculating the notional profit. This is simply the architect's certified value of the work minus the actual cost of that certified work. But hold on, we don't just take all that profit. Step 2 is calculating the actual profit taken. To play it safe, accountants generally only take 2/3 of that notional profit, and then they multiply it by the ratio of actual cash received versus the work certified. Basically, if the client hasn't actually paid you the cash yet, you scale down the profit you're claiming. Okay, but what if the contract is finally nearing completion? Well, the process changes just slightly because the end is actually in sight. Step 1 now relies heavily on estimating the grand total. You calculate the estimated total profit, or ETP, for the whole endeavor by projecting out your remaining costs. Step 2 calculates the profit realized to date by looking at the proportion of work certified against that ETP. And finally, Step 3 finds the profit for the specific current period by taking that total realized profit and subtracting any profit you already recognized in those previous years.
So the crucial point in all of this is this rule right here, the prudence principle. What happens if, during all these careful estimates, you realize the overall contract is actually going to result in a loss? Well, you cannot hide it. You absolutely cannot spread the loss out over the remaining years either. The rule is absolute. The foreseeable loss must be written off immediately in the period it's recognized. Honestly, it's a harsh reality, but it's exactly what keeps financial reporting honest and transparent.
Which leaves us with this final thought. We've seen how businesses allocate factory rent to a single shoe, how batching literally slashes unit costs, and how builders calculate profit on half-finished bridges. So could applying these incredibly precise order costing methods be the literal difference between a thriving business that scales and one that slowly goes bankrupt without ever really knowing why? Think about the businesses you interact with every day, or hey, maybe even your own. Are they just guessing, or are they actually costing? Thank you so much for exploring this with me today on The Explainer.